Hi. Hi, everybody. We are going to be looking at risk-based audit approach today. There are so many audit approaches, among which we have a system-based audit approach, we have balance sheet-based audit approach, we have risk-based audit approach, which we are talking about today, and so many more. What is a risk-based audit approach? And we are going to take a practical look at things today and taking the example from the ACCA PAC, which is good for any Institute of Chartered Accountancy worldwide that may be viewing my channel, whether it be for as a student or as a practitioner. Risk-based audit approach emphasize identification, assessment, and tailoring of the audit approaches or audit approach and procedures towards the identified risk and the assessed risk. I hope we understand it to that level. For risk-based audit approach to be used, first of all, the auditor must know the client, that is, know your customer, that the financial institution usually will carry out when you open your bank account. The understanding of knowing our clients will assist us to be able to identify the areas of risk in their business and how to approach our audit based on the assessment of risk that we have the knowledge of. Also, nowadays, there are some factors that could contribute to the use of risk-based audit approach, like organizations now are doing business without borders now. A little organization in a room can have clients, can have businesses all over the world now. So without complexity now, the auditor needs to ensure that the area or areas of risk in that business they major on their efforts. Also, risk-based audits can streamline the efforts of the auditor and thereby bringing the time they use and resources they use to down, and the fee comes down. Though at the same time, it now takes more technical person or auditor to be able to carry out risk-based audit approach. Having known this now, let's look at two example that comprises of two factors, one on land and building and the other on inventory. This is the example. Your audit firm has at its client a small manufacturing organization. The company owns the land and building in its statement of financial position, and which it depreciates for 50 years. Of course, you know we only depreciate the building. Land cannot be depreciated, it will only appreciate, and has always been valued at cost. So more information being given to us there, right? So the other major items in the statement of financial position is inventory. So two things, two areas of risk or information given us, inventory and land and building. So looking at these two items now, we can understand one thing. that for land and building, which we could confirm physically to be on ground, the risk is lower because the cost is already known and the method of depreciation is already established. So the risk factor in building being misstated, land and building being misstated is lower. Now let's compare that of inventory of a major organization in manufacturing. It simply shows us inventory is a major, usually is a major issue and a major amount of figure in manufacturing because they are manufacturing, they have a lot of inventory and could be manipulated and abused. So there may be a significant number of lines to count and value. The quantity also will change all the time because as they are purchasing stock, the stock is at the same time being depleted. So major area of risk for this organization will be what? Inventory will be a major risk aspect of their business. So if an auditor want to carry out business now based on audit risk approach, they will need to measure more on risk of inventory being misstated, whether overstated or understated or not accounted for, rather than concentrating energy on auditing substantiating on land and building. My name is Gbenga Olatunji FCA. For those that are just joining the channel, like, share, click the notification button so that you will be able to always see anytime we upload, and click all so that you will not miss any other video that we shoot out, and comment if need be. Tell a friend to subscribe to GJAMES Associates. We pride ourselves that you know it already. We are value to life. We are value to your business. Bye. So now, risk base is talking about considering or putting consideration on risk factors in our client's audit. Identification of what areas will affect the opinion. So, when we are talking about risk-based audit, the auditor must ensure that the greater efforts they can put in is directed towards ensuring and focusing on the risk areas observed in the client's business and documentation. And we are going to look at two different examples now. One is about land and building, and another is about inventory of a particular company. So let's take, for example, the growing complexity of the business environment increases the danger of fraud and misstatement